Good morning, ladies and gentlemen. This week I wanted to do something slightly different because the markets have been so quiet, there's been so little movement that there's very little to tell you about the week ahead. So I thought it'd be an opportune moment to actually look at much further ahead than a week. This in front of you is a monthly chart of the S&Ps, and I wanted to take a look at why I always say that topping is a pattern which lasts many months. Especially now that I keep on hearing calls about we're going to have a crash in the autumn and stuff like that. So I wanted to see how likely that was. Well, we have lots of bear markets to examine over the course of the past 20 years. We have the 2000 market, and then we have the 2007, 2008 market to examine the topping pattern, which are always very similar in our experience. If we go back to 2007, 2008, we can see basically that the market started its topping pattern in May 2007 and then traded in a relatively narrow range of 5 to 7% until December of 2007. And basically from January it started the bear market with the first wave and then the big move down throughout the course of 2008 and early 2009. So we have a topping pattern which lasts a full 7 months. In 2000, 99 2000, we have something much the same. After the initial top, which happened here in this is April of 2000, we didn't really start going down until the end of September, so basically October. This is again a 6 month topping pattern before the market started coming down. And every time, first of all, we had support at the Bollinger Band, at the middle of the Bollinger Band, and then we had a fall down. These time frames are important, and please keep them in the back of your mind as we go forward through this presentation and show you what happened to various asset class spreads over the course of those months. Financial markets, in my view, are a game of moving assets from one asset class or part of an asset class to another. It is almost impossible to have a bear market in everything. You can't have equities going down and gold going down and bonds going down, but it's a game of shifting money from one asset class or part of an asset class to another. Therefore, something must always be going up, or at least going down a lot less than something else. We're talking about relative speeds of motion. Here we have a chart of XLP over XLY. So we have consumer staples over consumer discretionary. It is naturally obvious that during times of bear markets in equities, you have actually a contraction in the economy. People have less money, therefore they keep on buying food, which is your consumer staples, and they buy a lot less cars or fridges, things like that, which are consumer discretionaries. Well, this here is the period of 2007. You can see how many months it took from in 2007 for this spread to actually break out of its pattern and turn the moving averages. The pink one is a 200-day moving average, and this one, the blue one, is a 50-day moving average. So The process, remember that we said in the previous segment that the topping process started in May 2007 and basically ended in December 2007. You could have sold in May and you wouldn't have made any money at all until very late December 2007, as the market just basically kept on yo-ing up and down around a 3-4% pivot point up and down. So here you have April 2007, and finally you have the break higher sometime in July, August of 2007, and from then on the market had turned both the 50-day and the 200-day moving average, and it was basically in full trend. And you can see that from when this moving average turned, which was August 2007, the 200-day moving average, the market never touched it again until early 2009, when basically the bear market ended and we started having the bull market. Well, what does that chart look like now? Fast forward to 2017, and here we are. We are basically nowhere near setting any kind of buy signal for consumer discretionary for consumer staples over consumer discretionaries. Both the 200-day and the 50-day moving average are on the way down. We need, probably, if we're going to have a crash, and who am I to say we're not going to have one? But what I'm telling you is that if we're going to have one, we need a lot of work at these levels to break these moving averages higher, and only then can we start having a sustainable thrust higher in XLP over XLY and have a bear market. We do not have any of the elements necessary for a bear market in equities to start today. Next, let us look at a chart of XLP, so consumer discretionary over SPY. This is the period in 2007 where it turned the moving average, and finally it made the break in November of 2007. So this spread tends to turn later than XLP over XLY, but I'm showing you a later turn. And again, once it turned the moving average and started moving substantially higher, it never touched the moving average again until early 2009, when the bear market was over. How does that look today? Well, again, nothing like it. 200-day moving average, 50-day moving average, all moving lower, and we are threatening a break of a level that basically has not been touched since 2011. So we can see that even the consumer discretionary sector over SPY itself is not ready for any move higher at this time. If we look at another asset class, and this is gold over SPY, we can see that the 50 and the 200-day moving average crossed, giving some sort of a buy signal for gold over SPY in September of 2007. This was more volatile and less clear than the other charts I showed you, but basically the 200-day was in uptrend all the way until July of 2009, and then made a further high when we had a panic in October 2011, But then, from then on, it has been in a complete downtrend. And at the moment, we are still below the 200-day moving average, below the 50-day moving average. We might be doing a lot of work here to break higher, but we see absolutely no evidence of it as yet. So, will it break higher? We have no doubt that at some stage it'll break higher, but it will take many more months of work here turning these moving averages before gold over SPY is going to be giving a buy signal. This is a chart of SPY over TLT 20 to 30 year bonds. You can see that the in basically the crossover of the moving averages happened in November of 2007, and then the market just didn't really cross the moving average on a sustained closing basis until May of 2009, when the bull market started again. And since then, it's been basically a sequence of higher highs and higher lows, a bull market. So SPY over TLT has been in a bull market. Fast forward to the current situation in 2017, and we have absolutely nothing seriously worrying at the moment. We still have the 200-day moving average moving up, and we have a stall out of the 50-day, but still absolutely nothing worrying, certainly not until we break this line at around 188 and we start for the first time making seriously lower highs and lower lows. But this is again going to take several months before we are told that people now prefer to buy one asset class over another, and that is bonds over equities. This chart is SPY over IEF. IEF is shorter terms bonds, 7 to 10 years. So you'd expect it to be far smoother, and it is. We have the breakdown sometime in October, November of 2007, just as the market was topping in the States, and we have then no touch of the 200-day line all the way out into the almost the second quarter of 2009, when the bear market was over, and then a series of higher highs and higher lows. Nothing to worry about here. The 200-day moving average is still going up. Even the price is above the 50-day moving average. Is there anything to stop it having a crash down to 2, even 190? No, but still no signs of any kind of a bear market. This is going to take many, many months to turn, and therefore this spread is telling you that the odds of a bear market developing in equities in the next several months are almost zero. From charts that are not worrying, let's go to one which is beginning to get worrying. This is HYG, which is basically junk bonds, against TLT, which is 20 to 30 year bonds. So basically what we're looking here is credit. We're looking at credit spreads between safest assets, treasury bonds, against company bonds rated triple B or below. This is what happened in 2007 when the data actually starts, and we have the start of a bear market almost immediately. It was the first market to break, and it topped out in June of 2007. So this was the leader. Credit was the leader. Credit almost always is the leader in bear markets, and also it is the leader on the upside. It broke in April with the close of 2009, with the low the of the market, and it has been stable to higher ever since. Fast forwarding to 2017, we have a huge double bottom in in the market in 2016, which is telling us that that credit is the only sector which actually has not recovered meaningfully. Credit has been the canary in the coal mine, saying that this rally in equities is actually not all that it seems. It is saying that the credit quality is awful and that at any stage this market could actually turn. Well, going here we are, we have broken in the past couple of days the 200-day uptrend, and the 50-day up is negative and basically starting to turn. That is why we sold a little bit of HYG last week, and we'll probably sell some more once it tries the 200-day moving average from underneath. But this is a chart which is telling us that people are still scared of lending money to companies, that they think that companies are over leveraged, and that there could be a rug pull of credit to companies at any time. If that were to happen, and if this double bottom went, equities would certainly give up the ghost, and you would have a bear market in equities. But what this chart is telling us is that it's going to take several more months for that to happen, if it is going to happen. And this is the one that is worrying, not the ones we've shown you so far, but this one is the one that's worrying, and even that one says it's going to take a while. Now we move on to the chart, which is actually probably the one that should react as one of the very earliest indicators, and this is actually TLT, so that's bonds again over XLF, which is the financial sector. If we have a bear market in equities, banks get killed because they don't get paid back. And this is the one which reacts the most to any kind of recession, and it is the one which reacts the earliest. We can see that actually the market broke the 200-day moving average in July, August, then retraced it in October, turned it in November, and then the market just started going, and never looked back. Fast forward to 2017, well, not a lot to worry about. The 200-day moving average is still pointing downwards. Even if we now were to break it, it would take a lot of work above 6 before we were ready to start going higher. This is basically the behavior of the market from 2009 till now. We are at the lowest levels almost of the whole retracement between 2009 and today. It's telling us that people still prefer, since 2009, still way prefer to be invested in even the riskiest equities in case of a recession over the safest bonds. Many months of work here before that trend can change. And here's another very interesting spread chart which was suggested to me by one of our viewers, and it's one which I never really thought about examining closely. This the relationship between SOX, which is the semiconductor index, and FXY, which is the Japanese yen. Why the Japanese yen? It makes perfect sense, because when the Japanese feel scared, or when the market feels scared, they take their money back home, they invest in Japanese yen for safety. Quite why the SOX, apart from the fact that the semiconductor index is very, very exposed to consumers, so unless consumers are buying electronic goods and therefore chips inside them, the semiconductors just die. The companies producing the semiconductors. So it is very, very sensitive to consumer demand. And that's why I guess SOX makes sense over yen. And you can see that in 2007 actually was a very good indicator. It topped out as one of the first ones in July of August of 2007, and then continued its fall all the way into April, May of 2009, when it finally turned the trend and started going higher. Fast forward to today, we are nearly at the highs. This is 2017. We have no worries in the market. We have the 50 and 200-day moving averages firmly higher. We have a market which is showing no fear. It is trending. It's saying that semiconductor stocks are doing great, i.e. consumer demand for electronics is great. Nobody is buying the yen. Nobody feels any fear. The market is just great. So we have all kinds of indicators, from the most conservative to the most outlandish, telling us that there is absolutely no worries in the markets today. Well, we can end our tour of the spreads with the chart that we started with, which is a monthly chart of the ES, which is the SPX basically. What did all of these tops have in common? Well, they had volatility up and down within a predetermined range, which was made over the course of a single month. So once that single month range was made, we had up and downs that were continued for a good 6 months, and that is what changed the trends in those charts that we showed you. Here we have nothing similar. So what we at a guess think is going to happen is that the market will continue pushing up to around 2500, and then over the course of the next 2 or 3 months is going to make that one move lower, like it did in 99 and like it did in 2007, and then it's going to churn at these levels for a good 6 to 9 months before it rolls over. We are so far away from all the supporting moving averages that supported the market here that we think that this move can certainly be deep and come down to below 2300. So we think that we are now in a 2500, 2300 range for a good 6 to 9 months before the trend changes, if the trend is going to change. We will not anticipate it. We'll keep on looking at these spreads all the time. And this is the importance of looking at the spreads continually. And we will keep on showing you these spreads over the course of the next months. And of course tweet to you any changes in those spread relationships, because the market cannot go down without those spreads changing. Thank you very much indeed for listening to us this week, and speak to you next week.